Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, investors. Today, I have the pleasure of interviewing Jacob Vanderslice, a co-founder and principal at Van West Partners, a Denver-based real estate investment company specializing in the acquisition, development, and management of self-storage facilities. Under his fundraising leadership, Van West has strategically deployed over $375 million in capital in value-add self-storage facilities across the United States, as well as Warren, Michigan, I believe. Welcome to the show, Jacob.
George, good to see you from Denver to Detroit. Happy to be here.
Yeah. Well, since I am in Detroit, and you mentioned that you do operate just literally 2 cities over from where I sit, thought I would mention that today. And somebody asks you, what do you do? How do you answer?
When my wife introduces me to somebody, her famous introduction on what do I do, she'll say he does storage, and that doesn't mean anything.
Right.
Yeah, we're my response would be we're a real estate investment company, and we've covered a lot of asset classes over the years. We did our first storage deal in 2015, and at the time it wasn't really an intentional strategic pivot. It was more just let's try a deal out and see how it goes. And went okay, so we did some more and just kind of organically evolved to being a self-storage owner-operator. So in general, we buy or build storage facilities in a variety of different target markets, mostly buy. Rarely do we develop, but sometimes we do. And we're simply targeting deals that are undermanaged, inefficiently operated, below market rents and above market expense loads. And our value proposition and value creation strategy is to simply operate them more efficiently. So that's what we're up to.
I love it. Yeah. And I know that we decided we're going to entitle this Vision for the Future, What's Next for the Self-Storage Industry. So maybe it would be good if you could just back up a little bit and tell us where is the self-storage industry, where has it been recently, and where is it headed?
Yeah, you don't go to high school thinking you're going to be a big self-storage person. In some years down the road, I was going to be a fighter pilot or something else. But here we are in storage, and as benign and uninteresting as self-storage seems, it's a fairly fascinating asset class within the real estate space. And really, the big difference in self-storage versus other real estate asset classes is that the fact the revenue is very dynamic and it's very granular. So we have thousands of customers paying us, $50 to $200 a month, whatever the number might be. They're all month-to-month leases. So even though we're a real estate investment company, to a degree, we're a retail-facing business almost before we're a real estate investment company. We have hundreds of customers moving in and moving out every month. And really, the evolution of the industry has been it's seen some pretty material changes in the last 5 years. And it's emerged into being more of a widely accepted institutional asset class versus being kind of the bottom barrel sort of an afterthought. The themes in the last couple of years, as it relates, I guess, first to consumer demand, is we saw a historic increase in consumer demand coming out of the pandemic, right? People were clearing out their third bedrooms for the home office. They were moving cities. There was a big fundamental shift. So storage demand went through the roof. Us and most other operators saw really unprecedented revenue, occupancy, NOI growth. And then the theme of 23 was kind of a moderation. People were going back to the office again. The kind of post-COVID boom had subsided a little bit. So 23 for a lot of operators was fairly anemic. And we're recording this, a month past the first half of 24. And we've, at least in our portfolio, we've seen kind of a meaningful comeback on consumer demand, occupancy growth. And the other big theme for the industry lately has been consolidation. There's been a lot of mergers and acquisitions, portfolio sales. But despite the consolidation theme, the industry is still very fragmented. Most facilities in the country are owned by kind of onesie-twosie, smaller operators. They kind of fell into the business. They maybe owned it for a long time and they don't manage it very effectively. So we still see a lot of runway for strategically on a one-off basis acquiring these deals that are inefficiently operated and then creating value, as I mentioned earlier. There's been a big shift in technology, of course, like everything in the world. Automation is changed the business quite a bit. Some operators can run their entire portfolio without a person at the actual location. We tried that for a bit and we failed some years ago. Not failed, but it just didn't go as well as we thought it would have. So we're kind of a hybrid between automation, but also having an on-site staff member. Having a person there for that customer service aspect, I think, is important to the customer experience. They can not interact with somebody, or they can interact with somebody based on what their preference is. But the technology that's out there right now, like smart locks, keyless entry systems, gate systems, camera systems, has really made the industry evolve. But as far as what we see in the kind of medium-term horizon, development, new construction has really subsided. Reasons for that are kind of obvious, but I'll call them out anyway. Debt's expensive, equity's hard to raise, land costs remain elevated, hard costs remain elevated, and we're seeing a big drop in new construction activity. So I think that's a good story for retaining occupancies and revenue. Self-storage is very kind of local supply sensitive. So all my future forward-looking statements are wrong historically. Sometimes they're right, but they're only right because I got lucky. But we like the story that we're seeing with consumer demand returning in a variety of markets we're operating in. We like the story on kind of reduced development activity. And I think the theme for the next few years is just more of a heavy operational reliance on the technology platforms that are out there, and being very cautious, because these are touch and go times, right? Big election coming up, interest rates, what's going to happen there? Is there recession looming? This recession has been around the corner for 2 years now, right? 2 years we've been talking about a recession next quarter, and it just doesn't happen.
We talked a lot about that on the prior episode. A lot of money been printed. Hard to say how long it's going to take for that sugar buzz to wear off. We've never added that much sugar to the economy.
Yep. But somehow it's hanging in there. I mean, we had a bad jobs report early this week, and then some new numbers came out today on that were more positive.
Talking about the jobless claims.
The jobless claims, and now the market's soaring. So the peaks and troughs, I think, are going to be a little more pronounced for the foreseeable future, for sure.
That's right. Yeah, and as we do head into a bear market, which again, there will always be a next bear market, expecting those 100-point swings plus in the Dow, that's to be expected. Well, I'm glad you mentioned the fragmentation. I'd like it if you could contrast with some other types of real estate. For example, I know that mobile home parks tend to be very fragmented, a lot of mom and pops. Would you say that self-storage is more or less fragmented than some other types of real estate?
Mobile home parks are, we know enough about those to be dangerous, and that's a fascinating asset class because it's a diminishing supply. So net, I'd have to double check this before I quote it, but take it for what it's worth. I think a handful of new mobile home parks open across the country every year, and dozens of them close for like a apartment development or whatever the case might be. So you're getting into an asset class where there's not a good story for more of them coming, and there's always going to be that consumer demand who wants to live in a mobile home park. In self-storage, it's very different, right? People are still building storage very actively in some markets more than others, even though I mentioned supply subsiding. Supply coming and going takes a long time to start and a long time to stop. So there's a lot of deliveries that were baked, 2.5 years ago. They're opening up right now in places like Phoenix, where you're going to see some big reductions in rents and I think consumer demand because of a supply shock. So it's a finite supply between the two asset classes. Self-storage leases are month to month, and a big difference here is that even though our customer base in storage is more sticky than you might think, despite the fact they're month-to-month leases, the tenant base in mobile home parks is very sticky, right?
Yes.
They've got their mobile home, bolted to the ground there. It's really tough for them to move if there's a rating.
Well, like $3,000, which
is
a ton of money. I mean, that's real money to anybody. But if you're in the mobile home park, it's for most people that's decisive. You just can't go.
Yeah, and there's been a lot of regulatory changes in mobile home parks, specifically in Colorado. Tenants have a first right of refusal. If the owner is going to take the property to market, they have to give the tenants time to get together and find the money to buy the park themselves. So it's been kind of a regulatory shift that makes it a little more touch and go depending on where you're operating. But you'll see some shops that do mobile home parks and storage in the same vehicle, and there's some similarities and there's some big differences there for sure. But the big difference, I think, is that new supply. There's almost no risk of new mobile home supply, and depending on the market, there's plenty of risk for new storage supply.
Yeah, interesting. An analogy to other asset classes in real estate that we haven't really had to worry about new supply for a long time. But post-pandemic, builders have finally come back in force. And I would say maybe between Great Recession, speaking mainly about multifamily here, up until, just a few years back, I think a lot of people are just looking at demographic tailwinds to push things along now, with builders very much back in the game. And we could have interest rates declining before we actually see a decline in new housing starts. So, wow, you really have to look at the supply side a lot more, I would say, these days. Anything you'd like to add?
Yeah, briefly, if you would have asked me 3 years ago, and leading up to getting the storage business, we did a lot of single family, tons and tons of fix and flips and rentals all over the country. That was our main line of business. So we know that asset class pretty well. And if you would have asked me 3 years ago, interest rates are going to go from X to Y over the next 2 or 3 years, whatever the time horizon was. What do you think is going to happen to values? And I would say values would plummet, right? They'd go way down. The market can't handle that. Well, I'm wrong usually. And I was wrong there. They went the opposite
But I
direction.
love your modesty, Jacob. I mean,
Well,
most people are not going to do that. I think most dangerous people are the ones that trust their own predictions. And I say that as an award-winning data scientist. I actually made predictions for a living, but I can't stand people that are overly confident in themselves. Nobody knows the future.
yeah, well, we get a little less dumb every year for sure. And we've been doing this for quite a few years, so I think we don't know what to do at this point, but we certainly know most of what not to do. But I would have guessed that values would have gone way down, right? And they went the opposite direction. Well, why did that happen? Supply constricted because sellers didn't want to pay off their 3% mortgage and borrow at a 7, unless it was a macro move, moving markets or downsizing or moving from the city to the burbs because they had kids. And dare I say now, as interest rates are on the precipice of going down, which they've already kind of started to, depending on what debt you're looking at, you might see a decline in values because you'll see an introduction in new supply. The market will shake loose, buyers will get back in, sellers are going to start selling more because, okay, now I can borrow maybe next year at a 5, right? Instead of a 6.5 or a 7, I can handle that. I'm going to sell my house. You've seen big increases in inventory in a lot of markets in the last month or so. Denver, for example, we just hit 10,000 active listings, which is a number of active listings we haven't been at since, I think, September of 2012. So that's an interesting trend. And you've also seen the ratio of active listings that have seen price drops materially increase in the last report that came out. So you got a 50-50, I guess, when you forecast prices going up or down with interest rates. And in this case,
Exactly,
they might
like
go
JP
down as rates go
Morgan.
down.
Where's the stock market headed? Prices will fluctuate.
Yes, yes.
Yeah, very good. And obviously a very odd cycle. This time we didn't have the builders building, so don't expect that moderation next time. Usually we're way overbuilding going into a recession, and takes some time, some recession time before that supply moderates. So yeah, very, very different situation. Well, look, you mentioned you like to buy the mom and pop stuff. I think you mentioned no advertising being one of the things that you like to look for because it really shows that you have the opportunity to optimize the asset. I know you mentioned that you're very customer facing because you've always got to get in some new tenants. Of course, again, it's sticky, like you said, not as sticky as mobile home parks, but people love their stuff.
They do. They do. We did a study, and we do these often here, but we analyzed our most recent fund portfolio. These deals are fairly young still, but they're starting to kind of get to closer to stabilization. We haven't owned them this long, but we found that over 50% of our customers in our Fund 3 portfolio have been storing in that unit for more than 3 years, which
Yeah.
is just astounding. And I guarantee you, most of them, if you do the math on the value of their contents versus the rent they've paid over
Oh
that
no,
period,
no, there's no comparing it.
they could have bought new stuff.
Do
Yeah,
you have a
yeah.
ratio for us? Can you tell us just how bad it is?
As far as what their stuff is worth compared to the
Yeah.
rent they're paying, no, we
Yeah.
don't, unfortunately.
All right.
But I could
Okay.
add that to the list of stats that we should probably pull.
Yeah, absolutely. I have
But
always wondered. Yeah.
you
Yeah.
know,
My
one
one trip to a self-storage facility made me wonder.
one data point I have though, we have a storage facility we don't own about 2 blocks from our office, and we had some extra space in the main floor of our office. We ended up leasing it out. I had a bunch of stuff down there, so I had to move it. So I put it in a storage unit, and I was like, all right, I'm going to deal with this stuff in a month or two. And, family
Yeah.
heirloom furniture, hiking gear. I have like 12 pairs of skis in there. And it's been 18 months. I'm still paying $300 a month because I don't have the time to deal with it. And it's enough to annoy me on my credit card every month, but not enough to put my lights out. So I just
Right.
haven't found the time to deal with it. That is the storage business right there. And I'm sure I could have bought all that stuff several times over at this point, that I've got stuck in there, but it's just out of sight, out of mind, and I haven't had time to deal with it. So that's the storage business right there.
Yeah, love it. Very true. Very true. And literally the best explanation for why it's true. I love it. Well, you do have many customers, but you also have less management than multifamily. I know a lot of our listeners here are from multifamily, love to continue to compare and contrast asset classes. So you're not completely out of the management business. You do have somebody on site, but my understanding is that it's not you're not paying anywhere near as much for that management as you would say for a property manager of an apartment.
So, George, I'll open up this commentary by saying the grass is always greener, sir. I've heard many times that, oh, storage, it's easy, no tenants, no toilets, no problem. And that could not be further from the truth. We have about 19,000 units around the country. And I guarantee you somewhere right now, someone's breaking in and stealing stuff, somebody's cooking meth, something's leaking, like something bad is happening right now somewhere in the country in our portfolio. So the differences, though, I guess, on a more positive note, and I'm going to sound like an oppressive capitalist here, but in self-storage you don't have any fair housing laws. So if someone doesn't pay, you can get them out quicker. You don't have to go through the courts. I mean, there's a whole process
Yes,
to it, but it's not like evicting somebody in New York, for example, from an apartment in Manhattan.
right.
So you can remedy delinquencies a little more efficiently. And overall, though, you're not on a 200 unit apartment building. Obviously, you've got 200 toilets or more, and kitchens and
Right.
appliances, and you got stuff breaking more often. In a storage facility, you might have one bathroom in the leasing office, and everything else is roll up doors and steel boxes. So the repairs and maintenance and the ongoing, operational expenses are generally lower than an apartment building. But they're still out there for sure. We have U-Hauls back into our gate systems all the time and break the gate. We have people backing into our buildings.
Oh,
But
wow.
it's definitely lighter on the OpEx side than, for example, multifamily might be. And you've got the advantage too of being able to, as I said, remedy delinquencies a little bit easier. But don't get me wrong, it's still very operationally intensive.
Okay, good to know. Good to know. Yeah, wow. Uh, watch out for the meth labs. So disposal though, when you have somebody a non-payer, how hard is it to dispose of their merchandise? I know that in multifamily, particularly in some states, I mean, it's crazy what you've got to go through and how long you've got to hold on to it. So how does that go? Let's say I've got, a bunch of junk. Sometimes it is junk. I look in my basement. I can tell you if I had to put that in a storage facility, I don't know if it would be worth $300 a month. But how long does it take for you to take control of that storage unit? And what do you do with people's stuff?
Yeah, it varies from municipality to municipality, but generally it's about 2 months. And the first line of defense, if you don't pay, we turn your gate access off. But then you might follow another car into the storage facility to get inside. Our second line of defense is we overlock your unit with a red padlock so you can't get to your stuff. Yeah, and finally, then we try to work with our customers as much as we can. We'll cut deals, we'll do payment plans, but sometimes they just go dark, right? They change their phone number, their email bounces back, we never hear from them again. So the final step is to auction the contents of the unit. And the auction is really more designed to get the unit vacant, cleaned out, and back in service to a paying customer, more so than it is to get money for the contents. Sometimes there's some value there, but generally there's not a whole lot of value. So it's an auction process, which again kind of varies from town to town. And then once the contents are auctioned and removed and the unit's cleaned out, it goes back in service, and hopefully we get a paying customer in there. But that's generally the process.
Yeah, definitely, definitely a lot of differences there. All right. Well, a lot of passive investors here. So I'd like to ask you, first of all, what are your rules for partnering with a sponsor? Say I'm somebody new, maybe I've invested in multifamily or some other asset class, triple net, and this is new to me. What do I really look for in a deal? How do I know that I'm getting a good sponsor and a decent deal?
Well, one thing that sponsors like to talk about and investors like to ask, but I think in the wrong way, is track record. It's all about track record. Everyone's gotten their pitch deck, the big IRRs and multiples that they put up
Right.
over the years. And this might sound kind of flippant here, but I think in this environment, track record matters less than it ever has before. And the reason I say that is you look at these pitch decks, and you've got all these round trip deals that they sold in 2021, early
Yep.
2022, 20 something IRR, 2.5 multiple. Look at how heroic we are. Well, that's great and good job on those returns, but everybody else was doing the same thing at the same time. All boats were floating. And unless you didn't have a pulse, it was hard to screw up a deal in
Right.
these crazy years that we've seen. It was the perfect storm of compressing cap rates, rising rents, and a historically low cost of capital. And that was just like crack in the system. It pushed values up, it pushed up transaction activity, and deals that shouldn't have been home runs were, even though they were poorly executed, that borrower or operator or sponsor was saved by all those factors I just described. So when you ask about track record, instead of asking about the best deals they've done, you might start by asking about the worst deals they've done. Tell me about your failures. Tell me about your deals that didn't go according to plan. How did you navigate it? And okay, I love seeing your track record. That's great on your little pitch book. You've got these IRRs and these multiples. When did you buy those and when did you sell those? What
Yeah, asking
environment
about
did those
vintage is
trade in?
huge.
Yeah, it's not so much. I mean, let's say you tell a friend, I got a buddy in the stock market that's just killed it. He's a stock guy.
Yeah,
Well,
probably made 20% this year.
yes. When did he go in? When did he go out? That's really it's not so much what the return is, but when that return was realized and kind of what market cycle that was realized in. So I think it's better to understand when you're talking to a new sponsor and getting to know them, understand where they failed and how they've dealt with those failures is really important. And you don't have to be necessarily a real estate finance expert, but understanding whether the assumptions that they're using in their model when they're telling you what their IRR and their multiple target are, are those assumptions reasonable and achievable? And it's totally subjective in determining the answer to that question. But what you don't want to do is invest in a deal that, say, is a 15% targeted IRR, and you find out that's the IRR if everything goes perfectly, and 3 or 4 very unpredictable things happen in the next few years, right? Maybe they're making a refinance assumption. Maybe they're assuming their interest rate's going to go from an 8 to a 5. On month 18, they're going to pull a bunch of cash out. So understanding the levers that are being pulled in these assumptions that drive those return targets, I think is really important. And I think to a degree, if you're making a passive investment as a limited partner, I think you're investing in the sponsor even more so than you are in their asset class. Like you might want to make a
Right, right.
storage
So to be
allocation.
clear, experience still matters, but you just have to take it with a grain of salt when they have 20+% IRR and selling in 2022.
Yeah, yeah. There were a lot of tailwinds that probably the sponsors, I'm sure, a good operator, but there were a lot of tailwinds that might have drove
Yep.
that value up, and they just happen to
Yeah.
monetize that deal at the correct time.
Great, great. Jacob, I think we're going to have to wrap the first segment here. Before we do, we'd just love to make sure everybody has the opportunity to reach out to you. What's the best way to reach out to Jacob Vanderslice or Van West Partners?
Folks can go to our website, vanwestpartners.com. They can email me, jacob@vanwestpartners.com, or hit me on LinkedIn.
All right, great. And yeah, stay tuned because in the second half of this episode, we're going to talk a whole lot about valuable information for passive investors. And we'll also help to understand some of the differences between self-storage and multifamily. So you won't want to miss. Thank you so much for sticking with us. Thank you, Jacob.